Welcome, guys. What is today? Today's the 26th, Friday, Christmas, the day after Christmas. And we are officially on day three. I just had a nice conversation with one of our students here in Munis who was explaining some of the things he's picked up from this entire boot camp so far. Eunice, you still there, yeah? I do want to just give
Yeah,
a bit of your feedback so far, what you've said. Just give me a little reminder, like you said, before you quite didn't have any idea what some things were. What was that conversation like?
I was just saying like some of the stuff I didn't even understand. Like I got to learn like what BOS meant or it's change of character, all of that, and I knew what premium and what discount meant. I knew a bunch of stuff I learned from the boot camp. And then I also taught us about the four phases of the market structure, and that was really important. And
Oh,
bearish and bullish and the differences and all of that.
nice, perfect. So with everything that we've put together, Eunice has a better understanding of how to navigate in the market. And today we're going to introduce the third phase of this. And for anyone who has not been here with us from day one, if you're checking this video out on YouTube, and let's say you started off and you happen to fall on this day three video, I reckon that you go watch day one so that way you can put the pieces together. The way I've structured this is very much like a puzzle. I'm giving you bit by bit, so that way you can piece it all together. At the end of the 5 day, you will have all of the necessary information you need in order to catch a trade with confidence because you will know from step one to step zero, from step one to step A through Z. I would have given you each of the necessary things that you need to do to lead you towards your trade, and you'll have confidence in taking that trade. So, without further ado, let's carry on with day three. Today, what we're going to cover is order blocks. Now, as I've said, we've already covered the dealing range, right? So I'm going to do a quick overview. We've already covered market structure, understanding price action. We've already covered that. What's going on, YZ? I got caught up with the holiday festivities, but no worries, my brother. I've recorded the previous videos. They're uploaded. I dropped the link in the chat. So if you need to review what happened in day one, day two, those videos are out, and now you're coming in on day three, which is fine. You'll still get a good understanding from today. But what I do recommend that you do check out day one and day two because that's how it's all gonna make sense to you. All right. But let's carry on. So we've covered this here. You guys understand the market structure, change of characters, breakup structures. We've covered the swing highs, understanding what the swings were, not the internal structures, not the internal structures within structure, right? Not these little internal structures. We've covered knowing that the swings are the higher range of them. We've covered that. So we know that for sure. I've explained to you guys, where's the swing highs and the swing lows. For example, you guys know that if you're marking out market structure, your internals, these internal highs, internal lows are not going to be what you consider your swing highs and swing lows. These are your swing lows. This is your swing high. This is your swing low. This is your swing high. This is your swing low. This is etc. Your swing high. And these are just internal structure. So we've covered that. We've also covered dealing range. I've explained to you dealing range from every place where there was a breakup structure. This was the last low that led to this high that broke this structure. You'll be trading within this dealing range here. These will be your two dealing range until price breaks again to one of the sides. If it breaks above, then this dealing range go from this low to the low that caused that break, etc. So just that brief overview. We've also spoke on the discount and premium range. So if price is bullish right here, the last move we had was this break of structure here. We've spoke on for after every break of structure, price must do what? It must retrace. And what does that retracement look like? We spoke on it. It's going to look like slow price action. Very slow, very slow, very slow until it reaches equilibrium and then price shoots up fast again. So how do we identify the equilibrium? We spoke on it. It's going to be the last low that caused the break of structure. We're going to put our fib tool from there, from the swing low, or from the dealing range low to the high. And then we find the 50% and under, and we know that this is where price is most likely to retrace to after the break of structure. So we will basically wait for price or take the sell with price until we reach these zones. And once price reaches these zones, we know the next expectation is for the market to respect and push high once again. Oops, push high once again and continue the bullish, excuse me, and continue the bullish pressure to the next side to break structure once again and continue the pattern. So we've covered that. So now the part that we have reached when it comes to order block is now if I'm here and I've waited for price to come to this discount range, question now is, Sauce, how do I know where to enter? Let's say this area right here, this line where this green lines up, it's a bunch of candles. There's a bunch of candles like such. We have a bunch of candles. How do I know which one to enter from? Right? Okay, so now this is what we're covering. This is what order blocks is going to be top. That's the topic of discussion for now. So let's go ahead and erase this for now and let's dive into some definitions. So first off, what is an order block? Okay, let's do that. Let's get the definition out of the way. Now, one thing I want to say is I'll repeat some of these things over and over. So in case you need to write it down, I'll repeat it, or let me know if you need me to repeat again, if there happens to be something that I say and you can't hear properly, just let me know. Give me 1 second, guys. Hold on 1 second. Okay. So where were we? Let's see. Order blocks. Perfect. So like I was saying, definitions of it. So whenever there is an order block that hasn't been mitigated. So what does mitigated mean? So an order block, you might see something that looks like this, bullish engulfing candle. So you might see, let's say, for example, in this case, you have this form right here, this zone right here. Let me make it less dark. All right, boom. Let's say you have this zone right here, which is a better, let's say yellow. No, it's too light. Too light. All right, let me just keep it with the gray. So we have this zone right here. And let's say within this zone, this is an order block, right? And this is how you mark an order block, by the way. The way you mark an order block, let's say you probably have a candle that looks like this. Actually, before I do this part, let me give you more of what this is. Okay. So we know that this black candle represents bearish. We're going based off of this, for example, my candle's lights right here. Black for me is the bearish trend, and the gray are when price is going bullish. Okay, so just so you have context on why we're using this color for now. So if you have this bearish candle that was printed, series of bearish candles printed. So let's say it was, let me get another one right here, like this. Make it a little bit more realistic of how the price action would look. Like this. And then you may have some wicks. This is something we spoke about on day one with the wicks, what they represent. So you have this little wick here, you have this wick here. You may have this one, let's say this one have a long wick like this. long wick. And let's say even this one, you have an indecision candle where it has long wicks on both sides. Okay. And then for this one right here, you may have small wick here. And then you may have, let's say, another bullish candle here. Let's make this one a little shorter. And then this one, you may get this small wick like this. Okay. Now, in this price action, so basically, what you're seeing is as if the market was coming down. It was a downward price action. Market was coming down, down, down. It was pushing downwards. And right here, let's see, market was pushing downwards. Okay. Boom. As the market is pushing down, assuming this blue line right here is the this is bearish candles, bullish, bearish, bullish, bearish, bullish, bearish again, and then you get this bullish push where let's say it looks like this more so. You get this bullish push, and you've gotten this change of character, which we spoke about on day one. You got this change of character. Okay. Now, make it bigger. Okay. So what we're trying to understand now is how to mark out an order block first. So before I speak on how to mark it out, what this represents is a bearish candle. An order block is a series, is a not a series, but is a bearish candle being engulfed by a bullish candle. And that doesn't mean just for bearish and bullish. It can be the other way too. When it's a sell, it'll be a bullish candle that gets engulfed by a bearish, meaning the next candle is extremely more than the previous candle. Now, yes, there's two candles here of bearish pressure, but the last bearish candle was engulfed by a bullish candle, as you can see here, leaving most of the time you'll find, leaving some sort of a gap or imbalance in between it. That's where you first identify as an order block. Okay. Same on this side. You have price was, let's say, was bullish, and then you get this bearish push to the downside by one candle in particular. One candle straight pushes the market, pushes against that previous candle and engulfs it. Okay. Now, there's order blocks everywhere. So I'm not saying every time you see one of these, you're just going to automatically assume order block, order block, order block, because you can say, oh, yeah, order block right here. Another one right here, order block, order block. There's a bunch of them. But the way you identify a proper order block, which we'll get to, is is by seeing this candlestick pattern. Just because you see an order block doesn't mean that you see a place to enter a trade. What defines a place to enter a trade is a supply or demand. Now, what qualifies something to be a supply or demand, it has to have broken a structure. Meaning, if there's a supply here, if this order block pattern, let me take this here, if this order block pattern was this, what makes this a actual supply for me to take a sell from is the simple fact that it led to a break of structure. See this high right here, this high led to this low that broke this structure. Then I can say, okay, this is a strong supply. So you can write that down. What makes a strong supply and a strong demand? A strong supply, we'll mark it right here, supply. Oops. A strong supply is a high that leads to a low that causes a break of structure, i.e., right here, caused a break of structure. If it does not cause a break of structure, it is not a strong supply. because this high was able to lead to this low and break underneath this low. And this was the low that led to this high. So when price came back to it, it broke under. That means there are more seller pressure to come under than there are buying pressure to push price up from here. So that lets us know that right here in this area, based on this order block, if price comes back up, I can position myself for a sell from this range, from this area right here. I can put myself here and place a sell from here with obviously with confluences. So you have we'd wait on lower time frame, and I would look to target the next low of it. So if price comes back up here, retrace, mitigates me here, I can look for a sell. That's one way, that's one zone that I can say is a strong supply. Whereas another zone I could say is another strong supply right here. Let's say we had the same candlestick pattern, right? Let's say we had the same candlestick pattern, right? Excuse me. We had the same candlestick pattern right here, right here. If we had the same candlestick pattern right here, would would this be a strong supply? Of course. Why? Because this high right here, this high, led to this low and broke underneath this structure. And that's what qualifies a strong supply and a strong demand. So if you don't have that, if you do not have that break of structure that it leads to, then you do not have a strong supply. Vice versa, I'll flip the chart. Same thing for a demand. This is what it would look like for a demand order block. You would have the obviously the color would be different. It wouldn't be as you can see. So just kind of understand with the imagination here because I flipped it. But it would be the black would be gray and this would be black because we're looking at bullish and based on my chart colors, it would be the other way. But you get the point. The point is the engulfing that leads to the break of that previous candle first is your order block. But that doesn't mean it's significant just because there's an order block there. But once that series of candles leads to a break of structure somewhere above the previous high, then you know that this order block is a valid order block. That when price returns to it, you can potentially look for a buy in this case, right? So we go back. So yes, so this would be one position that we could look to sell from up here if price was to come to it. And the second one would be right here, will be the second position. Okay. Now, how do you properly mark the order block? Is the next phase. Now, when price comes into a zone, for example, let me delete this one. When price, the market comes into a zone, it is considered mitigating it. When it comes into this zone like this, it moves its way up and finally taps into it. This is what we call a mitigation. Okay. So whenever you have an order block sitting like this, where no candles, not even the wick nothing has tapped it yet, even if it got close to it like this, but it hasn't been tapped. Whenever you get an order block sitting like this is called an unmitigated order block. So whenever an order block hasn't been touched, meaning wherever price hasn't come into that specific order blocks yet, it is called an unmitigated order block, meaning price hasn't touched it before. After it was created, price have not touched it. So that is another key sign that this order block is valid. That's another key sign that this is going to be a strong order block because the orders that lies within it have not been activated. Now, whenever price does come to the same order block, so let's say price already tapped this once, like this, and now price is coming back to it again. It's coming back to it again. So this is the second tap. Whenever price is coming back to the same order block, we don't consider it to be a order block that we trade again, because this order block now is like, remember, if you guys remember what I taught you in the day one or two about support and resistance, one tap, two tap. Who's to say one more tap, this becomes a support and resistance zone, three tap. And now this whole area is a retail support and resistance where price is most likely going to induce it and then continue to the downside if that's the move that it's looking to do. So whenever price comes to the same order block, we don't consider it to enter a trade again because it is already considered a mitigated order block. We only keep our trades open if we are already in the trade from this order block. So meaning if you was to enter the trade from here already, when price came in here, you got into this order block trade right here. You got into this first tap, then price pushes away. It hasn't hit your TP yet because your TP is here. And then price returns back to the zone. You can still keep your trade open simply because if price just comes deep induced, but let's say your stop loss was above here, it does a deep inducement and then continues to the downside afterwards while still keeping you in the trade, then that's fine. Then that's fine. You can just continue from there. You stayed in your trade. You didn't have to, you didn't, and then you hit your TP. You didn't have to add another position, etc. You just hold your trade. But don't go adding in a second trade. Don't go adding on top of it simply because you think, oh, this is my other chance to add more leverage to this first trade. That's not how it works. Because who's to say price won't just simply take out your actual position and now you've got two positions taking a stop loss versus just one. You don't want to get into that situation, okay? So that is the order block. That's how you mark out and identify an order block. Now, I'm not sorry, not mark out, but that's how you position for an order block that's going to be valid. It must be a supply, for example, is a high that leads to a low that breaks structure. A strong demand is a low that leads to a high that causes a break of structure. That's what makes a strong demand. What do I mean by a strong demand? That means when price comes back to it, i.e. this example, it's going to respect and push up again and break structure to the next high. Why? Because that break of structure is a confirmation of the trend. So now price broke this structure again. Next time it comes back down, is either going to mitigate the equilibrium within this range, this trading range, and then continue up again and gives you another break of structure until the trend ends, which you know how the trend is going to end. We spoke on how price will give you a signal. Signal of what? A change of character followed by a break of structure towards the opposite direction. And then you'll know, okay, we're going to be going the other way. Okay, so for that, now let me flip this right back one more time. Now this one is when it comes to marking out your order block. How do you mark it? Okay, so in situation, you have this particular candles pattern marked showing. How are you going to mark it? You have a wick to the downside, a wick to the top side, and you have a wick to the downside of this. Let's say there was no wick here. Let's say this was just a very, very strong bullish candle. How would you mark the order block? This is how you mark your order block. Order blocks are marked from the wick to the wick, and then you pull to the right. So it's not the wick to the body. It's not the body to the body only, and you leave, it's the wick to the bottom of the lowest wick of the candle that's being engulfed. Vice versa, same thing if it was bullish. You're trying to mark your order block for a bullish candle, a bullish and a bearish engulfing candle. Let's say this was your wick, and you've had this here as your other wick. You would be marking it from this wick to the bottom of that wick, and then you move your cursor to the right. And this would be how you mark out your order block. Now, what if there's a wick on this candle and that wick is way up here? Do you now mark this wick as well? Nah, you don't have to. Now, in the event that this wick right here is a news candle, let's say this whole candle was created during news, then it is likely that price is going to want to fulfill take some liquidity from the zone. At that point, then you do include the entire wick and you wait for confirmation. Because then when market comes and mitigate in here, it's not just going to shoot down, it's going to mitigate and it's going to create some more liquidity within it. And then it'll give you a change of character, breakup structure within the box, and then you can take your sell. But in a grand scheme, this is how you want to, on a perfect day, this is how you want to mark out your order block. Wick to wick, wick to wick, not the wick to body. All right. So let's quickly look into the chart so you can get an example of how you would mark an order block. Okay. So let's find a recent break of structure. All right. So we had this high leads to this low. This low led to this high. Didn't break above this high, but then this high led to this low and caused this break of structure to the downside. So what does that mean for us? That this low, this break of structure represents a strong a strong supply above. So we have this BOS, this bearish break of structure. I need to be able to get the text bigger. Okay. So what does this mean? If this is the high, let me use my highlighter tool. It's very, very important. Always use your highlighter tool. You have high, low. You have lower high, lower low. This is a lower high because this high is lower than this high. This is a lower low because this low is lower than this low, this previous low. So now, if we know after every break of structure, price must retrace. So now we're going to ask ourselves, simple, you're going to see everything we spoke about being put together right now. Okay, this is one of our trading range, something we spoke about. Let me make this a straight line. One of our trading range. Okay, we understand that. And then we also understand that this trading range that this breaker structure happened to is another trading range. But what do we say? The trading range moves after one is broken. So which one got broken? The one to the downside. So price lets us know we want to continue low. So now this is no longer the high of the trading range. This one now becomes the new high of the trading range. And this becomes the new low of the trading range because this is the lowest point that it reached when it broke structure. And this was the high that caused that break of structure, which makes it a strong supply. Why is it a strong supply? It's a high that leads to a low that causes a break of structure. No break of structure, no strength in the supply. It causes a break of structure, there is strength in the supply. So now, what can we see? We can see a bullish candle that got engulfed by these bearish candles. Now, because we're on the 15 minutes, it looks like it took two candles to engulf it. But if we go on to 30 minutes, you're going to see it's a very clear bullish candle, bearish candle engulfs it. And what do? From wick to wick, and you move it to the right. And what did the market do? Came back into it and dump, creating another break of structure. And that's how you identify your order block to enter a trade from. Even then, you can still do what we also taught you to do, which is from the swings, this high led to this low and broke structure. You want to know where is the equilibrium that price would like to retrace to. You use your fib tool And where did it come to? Right there above the 786 range. Because within your 786 range or above 50, there is no order block. The only thing that where the order block lies is right above it. And a piece of the wick of the order block, it lies within the 786 anyways. So by covering wick to wick, you're still in the trade. So you were able to position yourself for the sell right here. You cover the high of the where price came from, and you target the low of where it came from. And it gives you an easy 1 to 3. And this is just being modest. An easy 1 to 3, targeting the low where it's coming from. And this is a 5.8 pip stop loss. This is not no 30 pip stop loss. This is a very small stop loss. We don't take trades on stop loss that are above 7 pips. The maximum is 7. If a stop loss, if my zone, if this order block, when I position for it, even on a 30-minute, as you can see, this was from the 30-minute we marked it, and we still got it at a 5.8. If this happened, if this was a 7, I mean a 8, 9, or 10 pip stop loss, meaning I had to cover all the way up here, and I'm not taking this trade because look how my ratio goes from a 3 to a 1.6. But when you're very precise, when you're able to use the understanding that I've been giving you, then you don't have to cover so much ground because you know that this high is protected. This is a protected high because it's not the highest point, it's a lower high, and it led to a break of structure. For price to come and break above it would be a break in structure. The market always respects structure. So therefore, you don't have much to worry about. The only time the market will not respect this sort of a structure is if the retracement of this candle, this whole price right here, which we spoke about last time, if this retracement that price got to right here was not within a premium range, as you can see here, you see it came up to 786 zone right here. If it did not, if it was at the 30, at the 3.8, and then came and broke a structure from a 3.82, then yes, price would come up, break above it to finally reach the 786 zone and then break structure to the downside. And that would still be respecting market structure because it would be high, low, and then wherever the next high would be. Okay. So that's just for clarity. Let me find you another supply supply zone. Even though price hasn't reached this zone yet, as you can see, same bullish candle, bearish engulf. This is a high, this is a low. This is a high, this is a low, this is a high, this is a low. That causes this break of structure. And as you can see, that makes it a strong supply and price has not, oops, and then you're gonna pretty much mark from wick to wick, move it to the right. And this will be a supply you're expecting the market to come into and sell back down to break structure once again. Why do you know it's gonna break structure once again? Or why are you anticipating the odds of it breaking structure once again? Because it's already confirmed it for you here. It's already closed and broken structure with a body. Look at here, it closed structure with a body. Did it not continue after the retracement? Yes, it did. It broke again with another body. So what happened after this retracement? Oh, let's say for perfect example, we've just spoke about this. Look at this low. It broke structure to the downside. You may say, well, how come price this time came up, did not stop from right here and push back down? Why did it break above it? This is where we spoke about with the fib tool. So where was it? This is the high, or this is the high, I mean, that led to this low that broke this structure. So let's take a look here. Okay. All right. So this comes with liquidity, liquidity within Asia. So price, this is Asia high, I'll also give you guys some of these indicators. I don't really use indicators. These will be the only two that I use, Asian range and then the ICT kill zone. These are the only two indicators that I use. See, as you can see, it just highlights the Asia zone for me so I can know where the Asia liquidity lies. But as you can see here, this mitigation in the discount range that price had, it led to a low. Price broke structure to the downside, but it did not break the original low that price created the high from. This low that led to this high that broke this structure. So when price came and mitigated this low, remember what we said, a low that leads to a high that causes a break of structure, similar to a high that leads to a low that causes a break of structure, is a strong demand. So price came back to this demand. Now, remember what we said is we wick to wick and we move it to the right. Boom. And that's where price came to. Now, remember what we spoke on. If price has already mitigated the demand and comes back into it, we do not qualify it as a zone to take a buy from or a sell from once again. So when price came and tapped into the zone again, we've already got one time it tapped, two times, three times, four times in all of these series of candle. This is no longer a demand. This is now a retail support and resistance, like we've spoken about. This is a retail support and resistance of liquidity that are just being built for the market to take out, as you can see right here. So what did the market do? It gave a reaction. It gives you a reaction from this zone. How would you have known that this zone was going to fail? All of the liquidity that I taught you how to read. Look at this, trend line liquidity. They're all showing up in front of you. Market is letting you know, I'm coming back down. One tap, two tap, three tap, four tap, five tap. It's giving you the trend line that, hey, I'm coming back down. I'm just inviting buyers in. Why? Because these buyers are seeing low that leads to a high that broke structure. There are people, they literally only trade supply and demand. Like they don't even know the additional depth of understanding that you're getting. So for them, they just look for a high that leads to a low that breaks structure, and every time price comes to them, they take a buy or sell. If they hit stop loss, they just look for the next one. They just Russian roulette like that until one hits. So those are the same people who are being invited in this situation here, because what they're seeing is, well, the market has been bullish, bullish. It's been bullish this whole time, all the way up here. It reached this zone. It's just retracing. That's all they're saying. It's just retracing. But what do you know? You know that whenever price does a change of character followed by a break of structure, that is a signal that the trend is changing. If price would have simply just hit this zone, came back one leg, two leg, and came straight to the zone, then perhaps they would be correct, right? But that's not what the market did. The market came back down, retest, and I'll teach you guys about invalidation models later on in the week. There's something called invalidation model that lets you know when your demand is going to fail and when your supply is going to fail as well, which you'll learn later on. But in the event of this explanation, because of this zone not being a true demand anymore, because it's been mitigated multiple times before price came back again for the, I don't know, the 20th or 10th time, it gave a false reaction and did nothing but sweep liquidity of this high. It just came, swept this liquidity, and if we probably go on a different time frame, we could probably find a order block where it mitigated. Okay, it's a big one on the 4 hour. We don't want to use that one. But let's see, I'm sure 5 minute or somewhere we will find an order block, 10 minute. Okay, so you can see here there is this 10-minute order block. It'd be 15. No, on a 10-minute is probably one of the cleaner ones. You can see that there's this one bullish candle followed by these engulfing candles. And as I mentioned, on a different time frame, like if I was to look at like I'll say 12 minute, It'll probably be more clean. Yeah. Let me go 14. Perfect. So on the 14-minute, we'll get, most likely get the cleanest. There you go. So what do you see here? A bullish candle, wick to wick, that got engulfed by a bearish candle it leads to the breakup structure. That high right here led to this breakup structure, and it had a bullish engulfing candle. I mean, a bearish engulfing candle, yeah, bullish engulfing candle right there for price to come retest and push back down again from, because the sellers were in control of this whole move to then sweep this trend line and continue down. Now, price can continue its pattern, retrace, mitigate here, and continue down again. Okay, so that's one way of seeing order blocks. I might show you one more, and then we'll go on to the next phase of today, because next we have the supply. Well, we just covered supply and demands. I've showed you how to um, identify your order blocks, how to mark out your supply and demands, and I think what I'm going to do next is show you invalidation model. Okay, let's go to invalidation model. So far, are we clear? You could use the chat, guys. Are we clear with the order blocks and the supply and demand? I can move on to invalidation model. Give me a yes or a thumbs up, or if you need me to explain further, so that way I can move forward. I know the questions will be at the end, but just let me know where you guys are at with it so far. See the change of character. The change of character it will be more within the internal time frame. So if you go right here, this is where you see your change of character units. You see this, zoom in. See, let's say I bring out my highlighter tool. You'll see your change of character. That's why it's important to have your highlighter tool. You have low, you have high, you have low, you have high, you have lower high. I mean, yeah, higher low. You have higher, where is it? You have higher high. You have higher low, higher high, up, lower low. Now, what is this? That's your change of character. The last lower low, I mean, the last higher low that led to the higher high, then got broken, giving you your change of character. The reason we didn't go into that because that wasn't the focus for the order blocks. That's why I didn't go and do all that marking, but there goes your change of character. You just have to use your highlighter tool. On a higher time frame, you don't see it as clear when I'm on a 15, etc. But when you go to a time frame where structure is more, you can restructure better, like the 5 minutes and 15 minutes, you can see your high, low, high, and then the change of character followed by your breaks of structure. Okay? Cool. So now let's go to the next part here. Let's get to invalidation models. Okay. So the invalidation model is something that is very important to know and understand. So now I've showed you whenever there is a bullish price action, you guys already have this understanding here of these price actions. The market is pushing. The market is pushing. And then we know these highs. We know the change of characters. We see breaks of structure, break of structure. So we know we're in a bullish market. We also, you know that the last low that leads to the higher break structure becomes your position of entry potentially for an order block that lies within the premium level. Okay, we understand that. Now, invalidation model. Let's say before this bullish move, the market was coming downwards. We were having the reveal of market intent like this. Boom. We had a reveal of market intent like this. Okay. And now price has reached this supply. The market now reached this supply. This is a high, like we've just covered. This was a high that led to a low that caused a break of structure here. So we know that this is a strong supply. Okay, stay with me here now, guys, because this is where it's going to start making sense. So we've been bullish after the higher time frame. So let me put this box around this, right? Let's say this, all this right here is your, say all of this is your, we're gonna say this is about your 4 hour time frame. Okay. We're gonna say this is our 4 hour time frame. And we're gonna say this right here, all this right here is our 1 hour time frame. Okay, and we're gonna give the 1 hour time frame a different color as well. Make it blue or purple. Okay, cool. So this is our 1 hour. Everything in this box is our 1 hour. From this is 4 hours. So we know that the higher time frame holds more precedent. It holds more importance. If the high time frame, the 4 hours, and I'm gonna give you these time frames once again. These are the time frames that we trade. When I say trade, meaning we pay attention to. We don't look at every single time frame. Okay. One is going to be your obviously your monthly, your weekly, your daily, your 4 hour, your 1 hour, your 15 minutes, your 5 and 3 and 1 minute. Those are the time frames. That's all the time frame that you need right here. Okay. These are the time frames you start with. Now, the monthly and the weekly, even the daily, you may look at it specifically the monthly and the weekly. You might look at those like once every 3 weeks. You're not going to look at the monthly every day because not much is going to change on a monthly, on a daily basis. You're just taking a quick look at the monthly just to see where the market is at. You know what I mean? You just want to get the overall. I'll go to the monthly quickly for you. You just want to get an overall look of, okay, where is this market at? What is the direction? Oh, okay, look. By the look of this monthly, what do I see? High, low, high, lower, low, high, lower, low, high, lower, low. Okay, we're in a bearish market overall. That's what you're looking at the monthly for. Overall, I'm in a bearish market. So every one of these candles, each one of these candles represents 1 month. So this one small candle right here was all of last month of November. This one candle right here is all of 1 month of December. So that's why you're not gonna look at it every single day because it's not gonna be a lot of change. It takes 30 days for one candle to finish, and it's not gonna be one candle that just take all of this or do all of that. So you don't want to give it too much look every day. You want to keep studying the monthly. That's not gonna change much. Unless price reaches your destination, then you can say, okay, I've now reached a monthly POI. For example, this is a high that led to this low that broke this structure, right? And what do we have here? We have a order block, wick to wick, and then we can move it to the left. Then we could say, okay, if price is pushing up, where can it be going to? This might be the destination. This is where we can say, okay, this might be the destination where this price might be heading towards this monthly zone. Why? Because it was a high that led to a low that caused a break of structure. And this is phase two, because what? We could say this was phase one. Where's my thing? We could say this right here was phase one, reveal of market intent, right? This is phase two, the confirmation of the retracement through change of character and breaks of structure, which we on a lower time frame, obviously you'll see all of that. And when price reaches this destination, what could we expect? Phase one again. Why? Because we've broken structure here, so we'd expect price to come break structure again, type of a thing. Okay. So that's just the monthly. So you're not gonna sit there and wait all the like for almost 6 months to a year for price to finally reach here. Then you're gonna take a sell and hold it for an entire, I don't know how long. This was since 2022. The bottom was made in 2022. So imagine you're not gonna wait that long. It's impossible. Same thing with weekly. Weekly just gonna give you a little bit more cleaner look of the monthly, just a little bit more broken down of where that supply was that we spoken about. But those are just for that time frame. But the ones that we do look at and take a look at often is our, where's my marking? Is our daily, is the daily. These are things that we're gonna pay attention to. Um, I don't know what happened to the marking that I had, but looks like price decided to do its own thing. I mean the chart, whatever. The daily is for sure something that we're going to take a lot of like read. The 4 hour is very important because the 4 hour is where you're going to identify the structure, the trend. I apologize, not the structure. The structure comes from the daily, the monthly, and the daily. The trend is where you identify on the 4 hour. Okay, what is my 4 hour trend? We're bullish or bearish. Okay, cool. Because the monthly could have said we're bearish overall, but the 4 hour lets you know what's happening within the intraday. We're intraday traders. What's going on in the monthly is not going to affect the decision we're making today within a 1 hour, 15, 30-minute trade. That's not going to affect that. So what we're looking for is, what is the 4 hour telling me? Oh, okay, the 4 hour is telling me, I just went to the 4 hour now. The 4 hour, even though on the monthly we saw that we were bearish, but we were bullish internally on that retracement. But the 4 hour is telling me what? Low, high, low, high, low. Okay, so the 4 hour is telling me we're still bullish. Maybe up to where? Is it to this zone? Is it to this overall zone up here that we marked? That was the monthly zone that we had said, oh, perhaps this is where price is going to come to. I'm sorry, not the monthly, the daily. Oh, well, yeah, it was monthly. Or is it to this monthly zone that we had marked, that we said, oh, look, there was a bullish engulfing from wick to wick. That was the high that was the high that led to that low that broke structure. Is this where we're bullish up until at least? But we know that we get to that information through the 4 hour. So it's a puzzle you're piecing together. You're taking the information from the higher time frame and you're scaling to the lower time frame while still keeping the narrative of the higher time frame in your mind. You know that you're temporarily bullish internally up until these levels, for example, and then you know you're gonna go back pro trend for the higher time frame again once you reach that level. Okay, so that's why we speak on the 4 hours, etc. Okay, so then same thing, we look at the 1 hourly, but I won't keep going down the whole time frame and showing you, only because when we get to that part of the lesson where we're executing, we'll go on those time frame. But this time, these are the time frame I want you to remember. Keep that in mind. Now let me get back to the purpose of what I was trying to show you on here in validation model. Yes, now let's do it. So in the event you're in this 4 hour, as we spoke about earlier, 4 hours telling us what the trend is. Right now, we know the trend is bearish. Cool. The 1 hour is showing us that we had this reveal of market intent right here. And then all of a sudden, we started having these retracements. Boom. We're getting retracements. Price is retracing back up to where it is right now. And we know that retracements are much slower than the pro trend. That's why I'm scaling back right now. Retracing, retracement. Okay, boom. Now, price has reached its destination. So let me not use this right now. Boom. So we're going to say this area here is going to be your 15-minute. All of this right here. So let me also adjust this. Trust me, it all makes sense, guys. Don't worry. It's going to all make sense to where you will see the bigger picture. Okay, boom. And this is your M15, your M15/30-minute time frame. Okay. So now, what do we know about what we've learned with market structure? Okay. Well, one thing we've learned is that this was a low. We're gonna take out our highlighter tool. We know that the trend is bearish. This was the reveal of market intent. Okay. And I'm going to use this call out so we can say that. So that way you guys can stay with me. And those of you who haven't seen day 1 and 2, when you see it and you review day 3, it'll make sense. This right here, we know as the reveal of market intent. We spoke on this reveal of market intent, the 4 phases of the market. Boom. We know now that this is phase 2. We know that this was phase 2. Confirmation of retracement through change of character and BOS. We know this. Okay, cool. And we also know once price reached here, this is the completion. Oops. This is the completion of retracement. And the fourth step is repeat. Okay, repeat what? Repeat the pro trend, which will be price going to create a new leg to the downside. That's what we anticipating, okay? But what is someone else who does not understand market structure, who does not understand the narrative of higher time frame holds precedent, who does not understand that you're coming from this 4-hour time frame, who doesn't understand that this 4-hour time frame holds more precedent over this 1-hour time frame, over this 15-minute time frame? What does that mean? So what they're going to be looking at is this. They're going to say, oh, look, you have high, low, high, low. So I'm marking the swings. As you can see, I'm not marking these internals because they're not the ones that led to the break of structure. You got to mark out the swings. So what they're looking at, we're going to start from here. My apologies. Low, high, lower high, higher high, higher low, I'm sorry. I mean, lower high, yes, yes. No, higher low, yes, my bad. Higher low, higher high, higher low, higher high, higher low, higher high, higher low, higher high. But then this became lower. So what is this? You guys remember? Complex pullback. So now I can erase this one. I can erase this one. I can erase this one. And I can erase this one. Because now I know that from this low, excuse me, I know from this low, price led to this high, and this high led to this low, which swept the liquidity of these lows. Price just came back and took the liquidity. So this was a sweep. Because after the sweep, what did price do? Push up and gave another break of structure right here. So what does that mean for me? I know. Okay. It might be too light, too light for you guys to see. So I'm just gonna make it a little bigger. Stay with me. Stay with me. Okay. So we can see it. The break of prices came, swept, respected this low. This was a low that led to a high that broke structure. So technically, what did price do? It naturally came to, well, let's say there was an order block here. It came, mitigated that order block, and pushed off as normal. So what are those people are gonna look at? They're gonna see this low led to this high and broke this structure just like this one. And they're going to also say, well, because the shift, they're going to say the shift has changed. We're no longer bearish. We're now bullish. Price is going to continue higher now. So what those people are looking for is to buy from this low. They're going to see this low and they're going to say this order block right here is what they're expecting price to bounce from. I'm going to make this a different color so we can see it. And this is the definite the explanation of the invalidation model. I'm going to give it to you in words after. So what they're expecting is for price to come into this zone here. Oops. They're expecting for price to come into this zone here and then push back up and break above. But what we know, well, what you will now know is that because price came into this supply here first, we're going to put this as a supply. And we're going to put it to the top and we're going to center it. This supply, what makes a strong supply? A high that leads to a low that breaks structure. Always remind yourself these things until it becomes second nature. Keep repeating it in yourself as you're in a chart narrating. When price came into our high time frame supply, let me not just mark it as any supply. I'm going to make sure I put high time frame. Price came into our high time frame supply. Because the high time frame supply was mitigated, like meaning not before, because as you can see, there was no mitigation before. Because the high time frame supply got mitigated before price came and mitigated this demand. You're going to mark this as a demand. Because the supply was mitigated before the demand is going to fail. And I'll put this in in the writing. Whenever your supply gets mitigated before your demand will fail. Whenever your supply, no, whenever your demand gets mitigated before your supply will fail. Okay? It's that simple. It's just that simple. If price comes into your supply before your demand will fail because price has now activated more selling pressure, more seller orders to come down on your demand than it did if it was to do this. If price was to do this instead, reach this region, does not tap into the supply, gives you a break of structure, starts coming back to your demand, then you can say yes, your demand will give you the reaction you're looking for to buy up. You get me? If price doesn't tap into this supply, comes back into this demand, because you know what happens after a break of structure? You must get a retracement. So if the retracement begins before tapping the supply, so it means price didn't need to tap the supply to retrace. It started retracing after inducing this structural high, for example. Price induced this structural high right here, and then it starts making the retracement. Yes, at that point, you can expect price to come, tap you in, and push through into this zone. That's the definition. Your demand was mitigated before your supply, the supply fails. Your supply was mitigated before your demand will fail. And as you know, because we have reached the completion of retracement anyways, in the event that this is the case, reveal of market intent, confirmation of retracement, completion, and it's time to fulfill the repeat, then this is what you're gonna get. Price strong, bearish moves to the downside, and we're gonna break structure once again to do what? The same phases we spoke about, where this now becomes the reveal once again. And then we're going to get a series of slow price action, just like this, retracing again to come back to another level up here to do the same thing until price reaches destination. So that is the invalidation model. So now you know and understand how to identify the structure with change of characters and breakup structures. You know how to know what the trend is. You know how to identify a strong supply and a strong demand, one that leads to a break of structure. If it doesn't lead to a break of structure, it's not a strong supply, it's not a strong demand. So now by knowing that, you're able to position yourself for the right zones. You're able to catch the right sell, the right buys. Well, for example, let me give you another example of a supply or demand that's not a strong supply or demand. So that way you have a clear look on it. Okay. So we got a price action like this, for example. Now I'm going to also touch a little bit of some of the things we've talked about. We know here you have consolidation. Okay. You see these liquidities. The high got taken out, the low got taken out. Normal stuff. What else do you see? You know here you've got trend line. One tap, two tap, three taps. Okay, you have some of that. Now, this is a low that led to this high that broke this internal structure. Did this low break any significant structure? Let's first start off with the way you're going to identify the weak supplies and the weak demands, ones that are not going to be valid, is using your highlighter tool. Only use your highlighter tool and mark out or dot on highs and lows that caused something. If it did not cause anything, don't even give it a dot to confuse yourself. So we know that this was the low point we started from. Yes. We know that this was the high it led to. Yes. We know that this was the retracement low. Yes. Did this lead to a break of structure? Yes, right up here. Okay. Now, did this high lead to a low that did not break underneath this low? Yes, it did here. Now, did this lower high lead to a higher high? No, it didn't. It actually led to this internal high. Did this high lead to a low that was lower than this low? Yes, it did. So now this is no longer a strong low because that was simply internal structure. So that means this is no longer a strong high because that was internal structure. So now the strong highs are this zone. The strong supply will be this zone, and a strong demand would be this zone. Well, I'm sorry, not this one yet. This zone, right? It would have been this zone. So being that this was already tapped once, so when price came back to it, it took it out. But guess what? It respected this one. It respected this demand because this demand led to the high that most likely, let's say in this case, price was coming down. Boom, 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 right here. This was the one that caused a change of character. This was where your change of character happened at. So because of that, price came in, tapped into your change of character, and then now pushed up and gave you this break of structure. So is this here a strong supply? This high that leads to this low. One could say, well, this high led to this low and broke underneath these structures. But what did these lows lead to? What significant zone is the question you ask yourself? What significant high or what significant low did this high or this low this low lead to? It didn't lead to any. This low simply led to internal price actions. And this high simply came and swept these internal price actions. So this high is not a strong supply. This low is not a strong demand, even though it led to high, low, high, all this internal, these are internal price action. How do you give yourself better clarity to understand it? Is using your trading range, as we spoke about. So when this was the range, when this became your range at first, now make this quick and then we'll commence to questions, guys. So that way we can call it a day. Okay, so this was your trading range. These were the two areas. What happened? Price broke above one first, which was this one. Cool. So what does that mean? This is no longer the low of it. This becomes the low of it, and this becomes the high of it. Everything in between these lines are internal price action. It becomes something strong once it breaks above one of these lines or underneath the high or the low. That's why I said this was the strong demand. This is the strong supply. But once price broke underneath this low, then now your trading range became this range here from this high to this low. Because now this high and this low becomes the dealing range of your internal structures. Now that this low leads to this break of this high, now you have another move up. Now you go into this range and this range. Because this was the last low that led to the high that took out this structure. Now your new Strong's demand is here because this was the low that caused a significant break of a structure that has been crowned as a high or a low. See, so now we can see we have the swings properly marked. It's here, 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 here. You know what I mean? You have now your properly marked out structural highs based off of swing highs and swing lows, not just you're marking highs and lows of every single push up and down you see. You know what I mean? So that I hope that gives you a little bit more clarity when it comes to these markings of the swings, the highs, the lows, the zones that are significant and the ones that are not. So that way you can properly mark them out. And I hope this example also gave you a little bit more clarity on these higher time frames. When you're seeing those price actions on a higher time frame, understand those are the ones that are giving you the precedent, the trend of the market, especially on the 4 hour. I spend a lot more time on me personally, I spend more time on the 4 hour, the 1 hour and 15 minute. I don't really get all the way down to the 5 minute and 1 minute until it's time for me to execute a trade, meaning price is getting close to my time window, which we'll speak about later on, what I mean by time window and the execution windows and things like that. We will get to that point. But this was day three. We spoke on the supply and demand and the institutional footprints. And if we have any questions, guys, let's go ahead and dive into it now. And yeah, Let's get you unmuted. If you have a question, go ahead and let me know, and then or unmute yourself.
Hey, can we see what you just did on the chart real quick?
Which one on the chart like this?
Yeah.
I think I erased it. You want me to? I don't know if I could go back that far. Yeah, I erased it, brother. You talk about all the markings I did on here?
No, the finding the highest highs and the lowest lows with
Oh, down
the
here.
internal. Yeah,
It's about this one.
yeah. I want to see it on like the chart.
Yeah, 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 let's absolutely good call. So let's go to the chart. Let me show you from the chart. Perfect. So let me use a different, because this one's messy. Let me use the Euro Awanda. It's the same pair, just a different broker. Okay, perfect. Look at this, for example. If I'm now trying to mark out my highs and lows, right? We could see just off of just quickly looking at this, the internal, let me go to 4 hour actually, because 4 hour tells you the trend. What can we see here? We could see that the reveal of market intent was, let me shrink this down. Okay, perfect. Okay, so we can see that the reveal of market intent was coming from up here. Price revealed market intent right here, right? This is phase one, reveal of market intent. Came all the way down, broke structure to the downside. Cool. Now, if I'm marking out my structure, let's go from the high. I'm gonna say there's a high, this is a low. This is a lower high because this high is lower than this high. This is a lower low. This low is lower than this low. This is a lower high. This high is lower than this high. This is a lower low. This low is lower than this low. Lower high. This low, this high. Carrying on. Now, why am I not gonna mark this low? 1 second, guys. Hold on, tell my mom I'm on a call. Okay, so um that high, as I said, this internal high, I'm not gonna mark it as a low, even though yes, this high led to this low. It's internal. What do I mean? It didn't break anything. It's internal structure to this range. Remember what we talked about with the trading range. So let's say we started off from here again. It was these two. We were in these two dealing range. These were the two dealing range we were trading between. What happened? This one got broken. So now it became between these two dealing range. What happened? This low then got broken. Now it became between these two dealing range. What happened? This one then gets broken. So even when I come down to this here dealing range, before I even go to this here low, so move it, you can see this right here was simply internal structure to this low and this high. It didn't lead to this low did not lead to a high that broke above this one. This specific low right here. This right here, this low, it didn't lead to no high that broke above this significant high. Why is this high significant? Because it led to this low that broke underneath this low. That's what we spoke about earlier. What makes a strong supply? It must lead to a break of structure. What makes a strong demand? It must lead to a break of structure. So we know that this low did not lead to that. It didn't cause that. Okay. Then we say, okay, what about this high? Yes, this high led to this low that broke the structure, but this high was created by this low. So we can say that this high and this low, were simply internal structures so that we don't confuse ourselves and expect price to give us a reaction from this zone and sell down and break structure again. We mark out the strong high, the one that created, the originator. This is the originator that caused this break for price to come straight down to the zone and break this structure. So now this became our trading range. This high and this low. So when price comes up and breaks above, so on and so forth. So let me continue with the structure. So you know we have this low. Okay, what do we have now? We have a high. Okay, is this a higher high? No, because it's not higher than this high. Excuse me, it's not higher than this high. It is not. So it's not a higher high. It's still an internal high. Then we have this low. It's not lower than this low. So it's an internal low. Finally, price from this low pushes up, breaks above this high and this high. Okay, so now we can say we have an internal higher high, also a change of character based on this time frame. Now, are there structures inside of these zones? Yes, you can see all of them right here. These internal structures, these are structures. But we're not marking them right now because these are internal structures. When we talk about swing highs and swing lows, you're marking the ones that's the furthest out and that leads to something. So this high that caused this break retraced to this level here and had another push up that broke above this range. So now we can say this is the next higher high. And this higher high leads to this low. Now we're waiting to see if it's going to break above this high again to give us another higher high. That's how you mark out your swing zones. Obviously, when you go in lower time frames, such as the 1 hour, where it becomes important for you to then have your internal structures mark, that's when you can go ahead and start saying, all right, let me mark my internals. Then you got this internal high, this internal low, this internal high. Then you can say, oh, I had a change of character here. I had a breakup structure here. That, you know what I mean? Then you can get to you can narrow into your lower time frame change of characters, breaks of structures. But when it comes to overall identifying the trend and you're only at 4 hour, this is how you use your highlighter tool to guarantee that you understand the trend that you're in. And based off of this, we know we're in a bullish trend. Bullish trend towards where? Could be up to these zones, or it could be up to this wick here, like I told you earlier. When you have those long wick, you could see there was a engulfing candle here like with that example I gave you, you have an engulfing candle. Do you just mark this or do you take this whole wick? Because this was a news candle, I could tell by the length of this wick and the size of it, then you would mark out the entire candle with its news. And you can say, okay, this could be the first stop that the market gets to before it potentially gives some sort of a sell direction. So therefore, your bias becomes looking for buys up until you reach this region. And then you see, does price want to continue or is it going to give you some sort of a counter retracement somewhere to these levels, which I believe will be more of a counter, right? Why? Because we could see from this low that led to this high, did price get to 50%? Yes, it did, slightly 50%. The discount is still levels here that hasn't been mitigated. So price could come deeper if it wants, or it can finish off. As you can see, the 0.27 lies right within this region. So this could be where we get a mitigation. And finally, price can start giving us some selling pressure a little bit to the downside before we get bullish pressure again to come up. Because the market has to balance itself. Okay? Did that answer your
Yes,
question?
sir.
Hope that answered your question. Anyone else? Any other question? Feel free to unblock yourself. And tomorrow we'll get more into the kill zones. Kill zone is like the time that you want to look for executions. Tomorrow we're gonna try to dive more into the setup, what the setup looks like, and what else? We're gonna speak about Asia session, London session, New York session, understanding how those sessions work. So that way you're not just trying to trade all the sessions. You don't need to trade 2 sessions, 3 sessions. You just need 1 session. You can make enough money on 1 session, especially when you trade New York session. If let's say you're in the States, you trade only New York session. It's a lot easier for you because you have Asia and London information already printed. So it's easy for you to know where more of the direction of the market is. Because in New York session, it's only going to do two things: continue or reverse. So it's easier to narrow down which phase are you in, because London and Asia are already printed, so you can see once you come into New York, am I in phase one, phase two, or have I just completed phase three and we're in a retrace? So it's a lot easier when you're just focused on one session. All right, any other questions, guys? I don't want to hold you too long, but
Oh
I'm
my
also
God.
going to answer whatever
Those
question. Yes, yes.
coming late, but I don't know whether you had covered about this how to play out with the time frames,
Time frames. That's
especially when marking up.
time frames is tomorrow. As far the time frame
Oh,
to read the market or time frame for execution.
not read the market, especially when especially when I draw maybe when I draw this demand zone and on a 4 hour time frame, then when I go on the 15-hour time frame to pull it down so that it's not become so big.
Good question. Yes, tomorrow we'll dive into that, but just to answer your question now, when you have your higher time frame marked, for example, we have, let's say, let me say, let me go to, let's say this daily zone here. I think that's probably the perfect example. Let me just remove all this drawing. Okay, so let's say this daily zone here, all right? This daily zone, we see that the market is approaching it. Price is approaching, or it's in this daily zone. I think on this time frame, it shows that it's there, but on this time frame, it shows that it's not. Such a weird brokers. I hate when they do that. And also, guys, when it comes to using these brokers, use Owanda. Try not to use FXCM. FXCMs usually have manipulated price action for some reason, and this is not me bashing them or nothing. I'm just from experience. I've seen that. Okay, my bad. Monthly. So from this monthly time frame, what can we see here? Okay, we can see that price is getting close to this zone. Am I gonna wait here for price to make a trade here? As a matter of fact, I could even go to this daily one because this one is price is already there now. So this daily, let's say you had this mark as your POI, guys, and I'm gonna do it quick. Let's say you had this mark as a POI and price came into this POI. Are you gonna take a trade from this daily POI of a whole? This is about 40 pips, 41 pips. That's a crazy stop loss. You're not gonna make no money. No, of course not. What you're gonna do is you're gonna scale. Let's say price was getting closer to it. Let's say price was simply getting close to it and it wasn't there yet. Select bar. Let's say price wasn't there yet. And as price is getting closer to it, like this, you realize, okay, price is getting closer to my zone. What am I going to do now? I'm going to go down to the 4 hour. I'm going to see if I can find a smaller order block because I see I'm getting closer now. Oh, okay, there is a smaller order block. So now my my big daily zone that was marked is now refined. I refined it to now this order block. So now what was 41 pips is now 18. Okay, that's still too big for me though, but I'm going to see is price going to get closer to it. So I'm going to keep price action moving it, moving it, moving it. Okay, let's even go out. It went too fast. Let's go back right here. As a matter of fact, no, that wasn't too fast. That was fine. Price gets to it. Let's say price gets to it. Boom, price taps it. You say, okay, price is tapped into the zone. We'll go to the 1 hour. On a 1 hour, I would have said, let me see, is there another order block in here that I could see price potentially come tap into? Okay, this was where my zone is. I do see this one right here, but this is at the top. There's an Asia high. And I know Asia highs are liquidity, which we'll speak on tomorrow when I speak about sessions. That's where you're going to learn about the session liquidities. So would I still tell myself I'm going to look for this as my POI? No. At this point, I probably would disqualify this as my POI because I see that there's liquidity here, and there is a order block above. There's this zone above that price is probably going to come to. So I will no longer tell myself I'm going to wait for it here. But let's assume that this was not liquidity, right? Just for the sake of this example, I'm going to just speak on this just for the sake of this example. Assuming, so I'll even turn this Asia button off so that way a viewer don't say, oh, he's telling you guys liquidity is an order block. No, let's assume that this was not the Asia session and this was an order block. That's how I would refine it. I would refine it to this level and I would go down to a time frame like the 15-minute. And then I would see, is there any more, can I refine it any lower that is respecting my 7 pip stop loss range? And I will look, what do I see? Perfect. On the 15-minute, I have a 15-minute order block right here. And I would tell myself, I'm going to wait for price here. I'll even cover this one because the proper way to mark out a zone is to cover the high and the low of it. And I would say this right here, use my fib range, 5 pip stop loss. And that will be my entry if in the event this was the right zone, right? I would say I would wait for price to come tap me in and I would look for a sell from here, covering the high of it slightly with a 5.5 pip stop loss. And that would be where I would say I'm waiting for the price to come. So you see how I went from a huge daily zone that I expected price to sell from, because on a daily, I realized that we were there. I was already in that zone, which was right, you zoom back in, which was right, uh, which was right here. We were already in this daily zone right here. So now we were able to narrow it down to this tiny zone inside of it, waiting for price to finally come in there and give us a mitigation. So now I'm not doing anything besides what? Waiting for price. Now, did price come in there and tap me in? No. What did price do so far? Price came and gave me instead a change of character here, or a break of structure. I'm sorry. It gave me a break of structure since it is the 15-minute. It gave me a break of structure. So does that mean price needs to come up? It can. But I know that if I'm going to take this sell, I want it to sell from this premium. Why? Because this is a high, right? This is a high that led to a low, like we've said. What makes it a strong supply and a strong demand? This is a high that led to this low that broke under this structure. Why did I say this is a high that led to this low, and this is a low that led to this high, this is a high that led to this? Because these are internal. This is just internal of this trading range, of this trading range. You get me? And then I would say this is the reason why I'm waiting for price to give me a reaction from this zone, because it is a strong supply. It led to something. Now, this is in the perfect world, like I said, if there was not liquidity within this area, like those Asia highs that I spoke about. So tomorrow when we speak on it, then we'll see why I would then disqualify this entire zone anyways, because of the liquidity that's there. All right. So that to answer your questions briefly, but we'll go more into it tomorrow when we speak on the time frames, okay?
All right, thank you.
Sounds good, man. Uh, any other questions, guys? Any other question from what we spoke on from either day one, day two? The videos are also out for sure, YZ. No pressure, my man. So if there's no other questions, guys, I want you guys to have a good rest of your day. Have a good night. Tomorrow, same time. We're covered. We're literally about 2 days away from finishing. We have tomorrow and the final day on Sunday. I hope you guys have a lot of questions by Sunday, because after that, it's gonna be more so revision, and you're not gonna be revising with me on a call like this where you can just ask me questions that comes to your mind and I can answer. You're gonna be revising alone on those recorded calls. Now, if you do have questions when you're revising, use the Discord chat we have. Like I said, guys, don't be shy. This chat is specifically just the members in this on these calls and those who couldn't make it during the time because they're in different countries. So they're watching the replays. Ask your questions through there. So you don't have to feel shy. It's nobody like on high level of understanding the market that's looking at your questions and judging. That it's not that. None of my community is like that. Everybody helps one another. It's very supportive. But for the sake of this, I still made it where it's just you guys, this Discord chat, and I'm gonna be the one to respond. So if I see your questions, I'll answer it, whether it's audio or a text, or I'll even use a chart example if I need to. And here and there, I am gonna do Zoom calls on the regular community, which you guys will also be welcome to be part of. So you're part of the entire community in general. So when we do have those Zoom calls, show up, take some notes. There's no specific dates on when those will be, but when they do see the notification and you can make it, show up. That way you'll get some more advanced information of what's going on, and make sure you review your notes. Like I said to you guys, look, I have books myself, books of notes that I was taking. I gotta turn off my background because I need you guys to actually see this so you understand. This is not me just talking up out of my butt. This is books. Like, this is just one book. I'll go like this, of pages of notes that I've taken over my course of studying this market. This is books of studying. This is just one. Here comes another book. I run through books of taking notes from my mentor over and over and over. So if you're not studying, if you think you're gonna master and understand this thing just off of showing up to the call, actually that one I just showed you, this one is my journal, not my notes. This is my notes. This is from my mentor's private community. Books, like this is a big chunk of the page that just dropped. That's how much notes I'm taking consistently on every Zoom call I'm on. So when I tell you take notes, take notes, take notes, that's how your mind, your subconscious is gonna remember these things. This is not like anything else you've done in your life. I'm not even a person that likes to take notes and stuff like that. But when I realized I try to remember it on my own, I could not simply remember. I'm making mistakes left and right simply because I figured, oh yeah, I could do this easy. Da 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 da. That's when you start to make mistakes, and the mistakes is memory mistakes. And you always see it afterwards, like, oh yeah, I think he did say that. And you're like, yeah, yeah, he did say something like that. I'm not supposed to. Just gonna keep making those mistakes. You're gonna make your process longer than it has to be. I'm trying to help you shorten up your process. You don't have to take so many L's to finally learn how to trade. All you have to do is just fine tune, take notes, review your notes, and be patient. But I'm gonna get you to the finish line. Anyways, guys, that's all for the pep talk. I hope you all have a good night, and I hope you got a lot of good information from this call. And I'll upload this one tonight as well. Last night, it took me a while. Oh, and finally, I got my bag back from the airport. I know you guys went and picked it up today. They had it all ready for me. My laptop, everything was in there. Listen, that was a scary moment. Left my bag on the airplane, and this laptop right here is the laptop that I needed it anyways, because it has all of the recordings and all my old Zoom calls. So I'm glad I got it back today, man. Thank you, Eunice. Yeah, yeah. So I got my everything back. So we good. We rolling. So I'm gonna upload this video tonight, and it'll be through the same link that's in the Discord. If you click it, the third video will already be in there. And yeah, by Sunday, you guys will have everything, 5 days of the boot camp. And for the rest of the year, don't trade. I know nobody's trading. Don't trade. Don't look to be trading or anything. January comes, maybe like after January 5th. I know a person like YZ, he's been in the market in different ways, but don't trade until after January 5th because the market is going to be a little bit volatile. It's not going to move the right way. There's no liquidity creators in there. Like, the banks are not really trading right now. So if you're doing anything right now, you're going to be putting yourself liable to lose a lot of money. So don't trade. I stopped trading since December 21st. That's why I decided to do this call within this time, because I know I'm not going to be trading. I'm not even paying attention to the market. I'd rather revise with you guys by teaching and showing this, keeping the information fresh for me. So by the time January comes, I'm starting now analyzing the market. Right now, all I'm doing is back testing. I back test throughout the day, throughout the night of my strategy. Back test my strategy so I can see it working, working, and working, and working versus trying to be in the market losing money. All right, y'all. So without further ado, man, it was a pleasure working with you guys today. Let me see if there was a question in here. No questions in the chat. I'll see you guys tomorrow, same time, y'all. Peace.